got it? Credit derivatives is what I have prepared for you. Let's try and zoom in on this little booklet here. It is called Risk Management in Banking by Joël Bessy. He's a French guy. I think he's a risk analyst for BNP Paribas. You got it? So here it is. Risk Management in Banking, Joël Bessy with double E. It's an outstanding book. I have read personally about half, maybe 3/4 of this book. Very well written, very hard, fairly advanced. I'm actually thinking next year to make a risk management course. Half of it will be based on this book. The other half, I've got 2 other books on introductory books on risk management. So today's job at least is credit derivatives. So number 1, let's begin to write things out for you. Credit there's an interesting Wall Street saying that credit derivatives, at least understanding credit, knowledge of credit derivatives, got like a 1-year half-life. You know what's half-life? It's terms of nuclear and radiation. Half-life is the period for which half of the asset, or half in this particular case of the knowledge, kind of like depreciates. So the standard language on Wall Street is you don't have to even bother to learn credit derivatives, but that by the time you get to learn them, they've changed and transformed so much that your knowledge is completely obsolete and worthless. Now, the other saying or understanding was, this material is so phenomenally complicated, well, at least the quantitative side and the modeling side of it, that for 99.9% of people on Wall Street, it wasn't even worth bothering to learn and understand it because they wouldn't anyway, all right? So you got to understand, I'm here, it's a fairly hard, complicated job. Of course, everybody's complaining the job is, very hard and they're always, right, underpaid. But, so, number 1, what is the meaning? So, the meaning or the essence of credit derivative is 1, and it is insurance. Insurance, which is the same thing as protection. Of course, as any other insurance and protection, at least in terms of derivatives, back in the old days, futures and options, originally they were, of course, designed for insurance purposes, but over time the insurance purpose got perverted and a whole bunch of other goals and purposes were introduced. So, now let's move on to number 2, which is functions. Functions. And discuss some of the major functions which credit derivatives serve on the market. And first and foremost, or A, is to hedge risk. Now, remember, all we're talking about from the beginning till the very end today is risk. The focus is on, in this particular case, credit risk. And credit risk is more or less synonymous with default and default risk, which is the probability that in a loan, the loan will not be paid back in full or completely. So, in this particular case is credit hedge risk, and let's add to it that it is hedging credit risk, because you got to understand there's sovereign risk related to investing in some other countries. There is, let's say, interest rate risk. There's tons and tons of different levels of risk. We're focusing here entirely on credit risk. So, hedging risk is one important consideration. In other words, you invested in IBM or you invested in GE or in some other company's bonds. Again, we're talking here about credit, and if we're talking about credit, we either mean a bank loan or we mean a bond, a corporate bond. Now, it could be also municipal bond. Again, that's a different story altogether. But we're talking about here, usually the instrument which is hedged is bonds. So, number two is, once you get the ability to trade it, to hedge it, and it is an instrument, a standalone instrument, then you get the ability to trade it. So, the next one is to trade credit. So, suddenly, because you got an instrument, and because that credit derivative instrument itself becomes a standalone, meaning separated itself from the underlying asset. Remember, that's what is the purpose of some of the derivatives. You have an underlying asset, and the derivative determines its value based on the underlying asset. But the derivative, for example, a futures on stock, the futures contract on stock itself is a standalone instrument. The option on stock is itself a standalone instrument. So once you have a standalone instrument, of course, you can trade that instrument. So once you trade the instrument credit derivative, suddenly you begin trading in credit risk. Well, Wall Street loves that. Buying and selling and trading is one of the many ways that Wall Street makes a lot of money. Now, there is another important function. Again, they are all related within what credit derivatives are ultimately trying to do, is actually to separate. So, separate the risk, or separating the trading of the risk from the underlying let's just call it assets. Of course, we can call it credit, and credit is a financial instrument, which means that a financial instrument is always someone's asset and, of course, someone else's liability. So here the idea is that now you can get to separate the underlying assets and the risk from it. So this is identical in this example to a futures. You got a stock. The stock has some volatility. The volatility, upward or downward, represents risk. And if you buy a futures or sell a futures respectively, the futures itself separates the risk of that stock from the underlying stock. So suddenly you get a separation, and you can zoom in on, in this particular case, we're working the credit risk. It's all about credit risk today and in credit derivatives. So the separation provides a number of advantages, and this is one of the functions. Now, the one which turns out to be extremely important from Wall Street point of view, and especially, let's call it Bear Stearns point of view, right? They just got bankrupt a couple of weeks ago, is that these, and that's why Wall Street loves them, and that's why these proliferated, is that they are usually off-balance sheet. Off-balance sheet. What it means is that if you write a credit insurance, or if you buy a credit insurance, in either case, well, especially for the writing part of it, with the one that assumes the risk, actually is off balance sheet. If it's off balance sheet, it simply means that if you write in credit insurance, you assume the risk. You take the risk, but at the same time, you don't report it. And if you don't report it, the balance sheet will artificially underestimate the total risk of the particular entity or investment bank. So off balance sheet is extremely important to effectively cook the books. Cook the books. You understand what cooking the book means, right? I mean, at least it should be those studying corporate finance, is the idea that you try to use such instruments and such accounting methodology so as to intentionally distort the accounting statements so that they mislead the analyst or the investor into the actual risk or the actual, let's call it simply financial position of the particular business or institution. Alright, so off-balance sheet was one of the big beauties of it. And finally, with off-balance sheet comes another important part. It is called capital allocation. Let me explain this a little bit. Capital allocation is a fundamental principle in any risk-taking enterprise. The two big ones are commercial banks, of course investment banks also fall in this category, and insurance companies. If you take risk, you must provide for this risk. It's called putting aside or setting aside loss provisions. Or in commercial bank cases will be loan loss reserves. So you provide in your credit, you estimate the probability of a loss for that credit to be 1%. You immediately charge 1% to be a loan loss reserve. You set aside 1% so that if it defaults, you actually have provided some for it. Of course, we are expecting the law of large numbers to work so that you provide 100 loans, each with 1% chance. In other words, out of these 100 loans, you expect 1 to blow up and 99 to perform as expected. Well, when you set aside 1% for each, you're effectively expecting upfront that you're going to get that 1% loss. Well, that percent loss is part of the profits and loss statement. Well, where is the loss or the profit going? It's going into the capital, meaning the equity of a financial institution. So it is a part of the reserve, and the reserve is part of the capital. Well, the beauty of these credit derivatives is that there was no real actual requirement for them to set aside reserves. So if you're an insurance company, you gotta understand, you write one insurance for a car, let's say 10,000, you gotta put maybe 500 aside as capital to cover losses. You write a second car insurance, you put another 500 to cover losses. So you set aside capital as a reserve in case the risk materializes and you use those reserves to cover the losses. Well, remember, the concept here is that of insurance. So, like any other insurance, financial institutions should, at least those that assume the risk, meaning writing credit insurance, should effectively provide for such capital allocation or loan loss reserve allocation. It's also called provisions, and the process is called provisioning, and they did not. So they loved it. You understand, guys? So you're assuming the risk, but you don't put any capital aside, so no big deal. It's like free money. It's like me opening a major insurance company, writing insurance for anything I want to write, collecting the premium, but I don't have the capital. If I have to pay up, I can't. Alright, so it's the same story. Any questions on the functions as I'm done with the functions and I move on to the next subject? Any questions?
Are there any regulations that would obstruct the
Well,
lack of capital?
The idea is that there should be, from a theoretical point of view, there should be. Theoretically, it is understood. But because credit derivatives, and part of them will be these credit default swaps, do not have stringent regulation, these writers of credit derivatives effectively use that loophole in regulations where they actually abused it and they did not have it. So the answer is there should have been, but there wasn't. And that's why they proliferated. Alright? Because capital allocation means you put aside capital and that capital is locked. Alright? So, when you write credit insurance, you collect the premium, but there is a cost to that, and that cost is locking out capital. You can't use capital for anything else. We call in economics this an opportunity cost. Well, they were able to write the credit insurance without paying the opportunity cost. They were just getting the benefits. More questions before I move on? Any other? None. All right, let's draw a line here and put number 3, which are credit derivative views. So, there's a whole bunch of different views on credit derivatives. What credit derivatives are, what they do. And number 1, of course, is the most fundamental of all, is the so-called risk insurance. Oops, risk insurance view. Well, this is simply, I'm buying, let's say, the bond of a municipality, let's say bonds issued by Orange County, but I still want to insure the risk itself. So, at least back in the good old days, you'll get a monoline and it will insure it for you. So, this is also known as, if you guys can't see, just move up front over here and you'll be seeing a lot better on the back. Is so-called the risk transfer view. Risk transfer view simply means I'm not willing to assume the risk of Orange County blowing up on me, so I will transfer the risk to someone else, to an insurer who will insure it for me. So again, you gotta understand, this is identical. So risk insurance is the same as risk transfer. The insurance for one party simply means that, again, you gotta understand, the risk does not evaporate. The risk is not eliminated. The risk is there. It is present. It is always present. We just transfer it from me to somebody else, whoever the risk insurer is. And this is also known simply as risk hedging. So risk hedging, again, is the same concept, a third different way for the same thing altogether. Now, from this grows the next fundamental concept, and of course it grows out to be a view, the view of risk intermediation. Now, risk intermediation, you may should remember, is what Doug Nolan has been constantly talking over and over, at least 100 times, repeating that new function of these credit default swaps and in general credit derivatives. Now, credit default swap is an example of a credit derivative. I hope I can get to that today. So, what he was talking about is that Wall Street has gotten itself into a brand new business, and that is the business of risk intermediation. They take the risk, they separate the risk, and suddenly Wall Street has become from finance or financing, we also call it funds intermediation. We sometimes call it this financial intermediaries. What is the financial intermediary? It is the one that channels savings from those that have them to those that need them. In this particular intermediation, it channels risk or transfers risk from those that don't want to assume it to those that are willing to assume it for a fair compensation. Is this one clear? D? All right, let's move on. C is the investor. The investor view is also known as the so-called search for yield. So let's put in here, let me try this. Search equal sign to search for yield. That's not good. Search for yield or search for return. Well, when did these credit derivatives explode? Well, they exploded exactly when Greenspan slashed interest rates to 1%. You're getting 1% return. That is certainly not enough for anybody. Even for the most modest man on earth, 1% is not a good return. 1% nominal return is not a good return in any case. And certainly, due to inflation, a bad negative real return, unsatisfactory real return. So, these derivatives, guys, like any other derivatives, one of the nature of derivatives is leverage. So, you get yourself credit derivatives, suddenly you get yourself behind the scenes or inherent leverage. So, with inherent leverage, you enhance your risk, meaning, well, in this particular case, you assume the risk directly, but at the same time, you enhance your returns. So, you're an investor, you're not really happy with 1% risk-free by the government, meaning by Greenspan. You're going to go and assume some more risk. So, as an investor, you're going to be searching for yield. You're going to be pushing for yield. So, one of the terrible, and I mean terrible consequences of extremely low interest rates, even though borrowers may hail, hey, low interest rates are great for the economy, the answer is no, they're great for the borrowers, not for the economy. You got to make the difference. They are terrible for the financial system because suddenly all investors are extremely dissatisfied for their returns and they get to push harder and harder, meaning they go further and further into taking risk in order to compensate themselves for a more adequate, from their point of view. And suddenly what really happens is, suddenly everybody is taking more risk than otherwise they would. In other words, if interest rates were where the market would clear them, as opposed to where the central bank will peg them. So, suddenly, everyone's taking a lot more risks, and of course, if everybody's taking a lot more risk, the systemic risk in the system increases. As long as you got the liquidity masks the problems of the systemic risk. Once the liquidity evaporates, again, that's basic Doug Nolan stuff, suddenly the risk is exposed for everyone to see. Alright? Is that one clear? Do I move on? Well, there is that other view, which is part of A, which is called the risk management. Risk management management view is associated with portfolio theory. Any risk manager or any portfolio manager has got this fundamental trade-off between risk and return that is part of elementary portfolio theory, that the only way to enhance your return is that you must assume a higher risk. So whatever your underlying portfolio is, with a little bit of extra credit derivatives, you can enhance the risk, meaning increase the risk, and therefore boost the returns, well, the expected returns. Or alternatively, if your portfolio feels a little bit too risky, you can buy credit derivative, meaning credit insurance, and tailor your risk. So the risk management view simply says that no matter what your portfolio risk is, you can buy some protection and lower the risk, or you can sell some protection and increase the risk, and therefore tailor the risk exactly to your risk return profile. Alright? Is that fairly clear? Alright, so there is another E called risk arbitrage. The risk arbitrage view follows out of the next one, and the next one is, let me first throw it in, the so-called price discovery view. Price discovery is in the price discovery of risk. So, here is a simple concept. If you're going to be trading credit risk, apparently the trading, the buying and selling itself will give you a price. Well, as more and more people enter the market, buying and selling and making the market itself liquid, you will have a classical price discovery mechanism where a lot of buyers and a lot of sellers meet. You will discover what the price is, whether it's gold, oil, IBM shares, or any asset whatsoever. This is how you discover the price of an asset. Whatever the buyers and sellers are willing to buy and sell it for. In other words, you discover the price by creating a market. Well, credit derivatives allow you to create a market for risk, and therefore it allows you to price risk. Well, as long as you have price, now I'm moving to the previous point E. Anyone who thinks that the risk is overvalued will arbitrage by selling it, and others that think that risk is undervalued will arbitrage by buying it. Alright? So that will be one way to arbitrage. You simply believe it's undervalued or overvalued, and you take the respective position. And sometimes the risk arbitrage is, hey, you got GE and GM trading or having the same price for risk. And you say, it can't be that GE and GM have the same risk. GE is a whole lot safer than GM, at least any guy with basic understanding of finance in business will know that. So what you will say is, hey, I'm going to go long the GE risk, meaning I'm going to assume more of GE risk, and I'm going to short the other one, right? So the one is undervalued, you're going to buy more of it. The other one is overvalued, you're going to short it. And you're going to create an arbitrage. Well, that's arbitrage between two of them. Well, if you find 50 or 100, and some you believe are undervalued, now you create a portfolio of undervalued long positions, and those that you believe are overvalued, you short them. So you create a large enough portfolio which will effectively, if you correctly price the risk, and the market for one reason or another mispriced it, you will be able to arbitrage that risk and profit from it. Well, the arbitraging and profiting simply means that your view is better than that of the market. Or at that point in time, the market was mispricing. You believe the market is mispricing. You trade it, you arbitrage it, and if you were right, the market will reward you. And if you were wrong, well, you just lose capital. And let's see, risk trading. Yes, risk. So risk trading is another one. This is part of the trading where be here. So the next view is EFG, risk trading. Again, risk trading is part of the price discovery mechanism. As long as you have risk trading, in other words, creating the market for it, the result will be price discovery of it. All right. Any questions up to this point before I move on to the next issue? Any questions? No. All right, let me wipe off, and we're going to move on to specifications. So what is typically in a credit derivative contract? So, number one, and I'm going to be getting some help from the book, is anytime, well, let's me write this out with red here. That's number, specifications, number 4. So, what's a credit derivative? In this particular case, instrument have in general. And number one, in general, you must have, of course, like any derivative, the underlying. So it must specify the underlying asset. All right, let me get some help from the textbook here. Credit, okay, the functions, views, mechanics, underlying asset. So first of all, I gotta first define actually what is a credit derivative instrument in itself. So a credit derivative instrument is an instrument or a contract which exchanges payments triggered by a credit event of an underlying asset or basket of assets. So, credit event. So, the answer is simple. As long as there is credit event, suddenly some payments are triggered and the credit derivative becomes kind of like active. Credit event is kind of like car insurance. You got a car insurance, there's got to be some sort of an accident. You hit your car, well, that's like an insurance event and the insurer might be paying you. Number 2, your car was stolen. Well, that's an insurance event. The insurer will pay. So some sort of a credit event will have to occur, and then begins the machinery, whatever happens in a credit derivative. I will be explaining soon what is the credit event itself. So number 1, underlying asset. It could be, let's see, what do they give here? It could be a bond, of course. It could be a loan, and it could be a credit asset. Well, one example of a credit asset might be, let's say, a portfolio of student loans is one example. Another example of a credit asset might actually be, hey, why not just mortgages, all right? A third example will be, what is it? Credit card debt. You package a whole bunch of, let's say, 1,000 credit card holders, their debt, and suddenly you got a credit asset. All right, so these are sometimes called asset-backed securities from previous time. So why did they even put in an asset-backed securities, ABS? So that would be an example of examples of underlying asset. So within the underlying asset, there is another very important concept which is applicable to all derivatives, futures, options, or anything else. This is the notional amount. So what is the notional amount? This is the value of the underlying asset for the whole contract. Let's throw a little example here. You have on the futures exchange, on the COMEX, you have 1 ounce gold futures contract. Well, 1 ounce is currently trading, well, it's like 9.30 today. So the total value will be 9.30 per ounce times 100 ounces will give you, what is it, $93,000. $93,000. So $93,000 is the notional value of the gold contract. So if the full contract was to be executed, in this particular case, you pay up the full amount and you get a delivery of the contract, then the notional amount will be what you're going to be paying, whatever you've contracted. Another example is, well, 1,000 barrels is one futures contract of crude oil, and currently crude trades, well, what is it? 101. So the total notional value of the contract is $101,000. Is that fairly clear? Well, if you have credit card balances, and let's say you have 100 credit cards, the outstanding balance is $1,000, the notional value will be $100,000. So notional amount is applicable, is a concept which is applicable to any futures, to any options, and for that matter for any derivative contract. Represents the value, the market value of the underlying at, let's say, the contracting time. Is that fairly clear, guys? Anyway? Alright, so that's the notional amount. Let's see. Another important characteristic is that of course, leverage. The idea for the, let's say, 1,000 ounce gold futures contract is that when you are assuming a position, a long position or a short position, doesn't matter which case, if you're assuming, let's say, a long position, you got to put a margin. Well, that margin is not the full notional amount. You got to pay up roughly, let's say, $5,000. Well, $5,000 is for the gold contract out of 93,000 here is roughly 5%. So you are paying up for your part of the contract only 5% of the full notional amount. In other words, with 5% of the notional amount, you control the complete notional amount. So suddenly, you got a leverage. What's the leverage in this particular case? Come on, guys.
20 to 1.
Huh?
20 to 1.
Yeah, 20 to 1. 20 to 1. That's the leverage in this particular case is 20 to 1. Well, it's going to be a quite similar concept here with credit default swap. You just, get some insurance, all right? And that insurance provides, like any other derivative, provides some sort of a leverage. Well, this was the idea that they were writing out to the point of trillions. Bear Stearns, I was reading just recently, they had a notional amount of $10 trillion. $10 trillion. Can you imagine that? $10 trillion. Well, now with the notional amount comes leverage. Now let me provide another one which is not part of this, but it was part of the research and part of the the Bank of Settlements in Switzerland, is the risk. The risk is estimated to be, for a large diversified portfolio of derivatives in general, is estimated to be 2% of the notional. So let's put in perspective now. These guys had a bunch of $1 trillion in credit derivatives, and 2% of, let's say, 10 trillion in derivatives were what? 2% of 10 trillion in derivatives? They were having value at risk. What is 2% of 10 trillion? What is it? 200? Or is it 20,000? All right, well, let's write it out. So, let's say 20 trillion, and we take 2%, so suddenly you have 400 billion. So, you see, they were having, and this is called the risk, or also called, let me put in here, value at risk. In this particular case, value at risk is roughly about 2% of the notional. So anytime you hear, well, they got 1 trillion in derivatives, you got to understand that they always talk about the notional amount of the derivatives. And then if you want to compute the value at risk, how much are they risking really? Because they're not, of course, risking the full amount. They'd be risking roughly 2%. Well, for some derivatives it might be only 1. For other derivatives it might be 3%. Again, it depends on the underlying volatility, the volatility of the underlying asset. Alright, is this so far clear? Alright, let's move on and see what else do I have. Alright, so that's number 1. Let's draw that line here. Number 2 will be payment terms. So, if you guys are going to be having a credit derivative, just like if you're having a car insurance, there has to be some stipulation as to what are the payment terms. In other words, when there will be payment, what for, etc. So, the first key is that there will be periodic payments. In other words, those people that get insurance, or those people that buy insurance, will have to make a periodic monthly payment to those people that sell insurance. So you buy yourself a car insurance, every month you're paying $30 or $50 or whatever, $100. And in this particular case, these periodic payments are typically annual. Once a year, the buyer of protection will be making an annual payment. Alright, so the next one is called, and let's put it in here, termination payment. Now, this periodic one is the price you pay to get insurance. We have a name for it. It's called the premium. So, premium is the price that the buyer of insurance pays for any insurance, car insurance. So, termination payment will be, in case there is a credit event, what will the seller of insurance be paying? So, what is the arrangement? There's got to be some specification which says what exactly will be happening. Another important definition which is necessary is called post-default post-default value. So post-default value is simply, for a credit derivative, the hedge is that of a default. In case there is a default, of course, you have a post-default value. And post-default value is simply what is the value of the instrument once the borrower has defaulted. Well, you gotta understand the value is not zero. Just because the borrower defaulted, like let's say Orange County, it doesn't mean it will never ever pay back so that the value is zero. Well, they'll be late, they'll be having trouble, there's going to be some complications, you got to put in here probably legal costs for litigation. Well, they also have some security as in collateral, so you got to take the time, the legal expense to liquidate the collateral. Now you got to evaluate what the collateral is worth, when you're going to get it, and ultimately you should be able to determine the value of the security post-default. Well, this is actually what's got to be part of the contract. Who determines it? Is it going to be a third party? How shall the post-default value be determined? Of course, there may be active market for the security, and if there's active market, you just take whatever the market trades at. But many times there will be no market trading once there is the default, and suddenly you gotta have a mechanism to determine what's the post-default value. Of course, you have original value. What you need is the post-default value, which represents the loss of value, and the idea is that the credit insurer will cover that loss. So, if you're going to be covering the loss, clearly you know what was the original or notional amount. You got to determine what's the post-default value in order to get the difference. Is that fairly clear, guys? Does it make sense? Alright, let's see what else. And finally, after all of these, you got to determine one way or another the payout payment. Again, you can do all of these computations and everything else, but if you not define how will ultimately be paid out, when, within what period of time, how, in what form, etc., etc., the contract is no good. I mean, like any other insurance, you gotta say, the insurance company shall pay within at most 6 months of the credit or insurance event. So, that is a necessary part. Let me see if I have, let me try to, I never actually defined the parties. I've been constantly using them. I did define them some time ago. Let me do part of here 3, and we call this a contract parties. So, number 3, who are the contract parties? And let's try to call this. Number 1, protection seller. And number 2, protection buyer. So the protection seller sells the derivative, and the protection buyer logically buys the derivative. Okay, seller of protection is the same as buying risk. To buy, buying risk. You see, if you're selling a credit derivative, you assume the risk. This is as if you're buying the risk. And if you're buying the protection, you're effectively selling risk. Alright guys, does it make sense? Protection is the exact opposite of risk. Buying protection is the same as selling risk, and selling protection is the same as buying risk. Is that fairly clear? Does it make sense? Let's see what else. Well, the payment itself, as I wrote it, is called, the payment is called premium. So the buyer of protection pays the premium, and the seller of protection receives the premium. Okay, so let's move on. Number 3, 4 becomes legal issues. Okay, the most important legal issue which has been resolved, at least in the United States and many advanced countries, is separating the derivative from the underlying. Well, this is only common sense. It is perfectly logical, but from a legal point of view, it has to be definitely resolved. So, if I will sell insurance for a GE bond, and if he's going to buy insurance for GE bond, there is no necessity for me to own the GE bond, or to have a short position of GE bond, or for him to own the GE bond or to short it. In other words, you can completely separate the credit, the derivative instrument from the underlying, and this is and has been legally resolved, but it has to be before any trading can occur. Just the nature of things. Now the second is that allows, of course, transfer of risk. This follows from the first one. Of course, if you can separate the credit derivative from the underlying, it allows to transfer the risk without actually transferring the underlying itself. In other words, I can insure bonds, but I don't have to actually transfer the bond itself, either buy it or sell it. Similarly, you may want to take a credit protection of the bond without actually owning the bond, right? Well, if you try to take the protection without actually owning, it's going to be, of course, a pure form of speculation, of leverage speculation, or part of a arbitrage, all right? So that's a legal issue which has been naturally resolved. All right, so now we get to the next concept, number 5, and that is the value of payments. The value of when a credit event occurs. So, if there is a credit event, so the car crashes, or the car is stolen, or there is a hail, and the hail, with the big snow balls, they damage the car. What is going to be the value of the payment? So, what is the insurer going to pay to you? It has to be determined. So, number 1, you gotta have the concept of initial reference price. So, initial reference price is the price of the underlying asset during the initiation or the original buying and selling, the creation of the credit derivative. So we're beginning a credit default swap on, let's say, GM bonds. Well, currently GM bond is trading at 70. So we'll get to peg the initial reference price, the reference refers to the underlying, at 70. And only then we'll be doing what we're doing down the road. So when we're beginning, we gotta say, hey, this is what the price is today. Similarly with the car insurance. Can I insure my car for $20,000? Well, the answer is no. My initial car is worth maybe $6,000 level. So the initial reference price is $6,000 in the first place. All right. Then you have the post-default price. So the post-default price simply will define exactly how we're going to determine the price after default. Of course, if it is traded, solution is simple. Just take the market price. But the problem is it won't be always traded. So if it's not traded, it has to be calculated. Well, you'd better, especially when you're buying protection, you'd better have a clear understanding how will be computed so that you know ultimately what you're going to be getting. All right, there is one other, it's fairly complicated concept, is that of a multiplier. You gotta have a built-in for a credit default swap or any other credit derivative, some sort of a multiplier. And that multiplier measures the duration until the expiration of the credit instrument. So let me explain this. Do you guys understand the concept of duration? How many of you understand? Can you raise the hand in finance, in investments, the concept of a duration of an instrument? You guys understand it? You guys are asleep? Alright, duration simply measures the average time of the cash flows for which an instrument is fully paid for. Let's try and give an example. Today is 0, and this is year 2, year 1, year 3, and year 4. So, duration is, suppose you got a bond, it's a bullet bond or balloon bond, it pays the full amount, 1,000, in year 4. Well, the duration of the instrument is 4 years. So, you get your cash flow entirely in 4 years. Alright, so case number 2. Suppose the bond or the instrument is paying in year 3, 550, and in year 4, 550. Well, then the duration is 0, 0, 0, you know, 1/2 of the payments here, 1/2 of the payments there. So the duration of this second instrument will be, let's call it 3.5 years. Alright, so this is the weighted average of the payments. Then, suppose there is a third case. You have, let's say, 350, 350, 350. Now, you take the weighted average between 2, 3, and 4, and the average is, let's say, 3 years. And one last case. You take, let's say, an instrument, it pays back 1,000, and then it pays only 50, and then only 50, and then only 50. And the average, again, I'm just, giving you rough numbers, is going to be like 1.2 or 1.1. Alright? So essentially, you take the weighted average of the amount, it has to be precise, the discounted cash flow, discounted for the interest rate or for the required return, and then you multiply, you weight it by 1 for the first, 2 for the second period, 3, and so forth. So, if the bulk of the payments is in the first year, the duration will be close to 1 year. If the bulk of the payments is in number 4, the duration is going to be close to 4. If the duration is, if the payments are uniform, it's going to be almost the middle of the full period. Do you guys now get an intuitive understanding of duration? Alright, now we move on to the concept of risk. You have two instruments with the same cash flow, net present value of 1,000. The answer is, or the mathematical property is that the higher the duration of an interest, of a cash flow, the higher its risk. Alright? So, if you have, for example, an instrument of 1 year in duration, if interest rate moves by 1%, the value of the instrument will move roughly by 1%. Now, for example, if you have a 10-year bond and let's say the current interest rate is 5% and for 5% it moves to, let's say, 4%, the difference, the bond's going to go up a lot more in price. So a 1% interest rate move will have a magnified effect for an instrument with a high duration. It's going to have a fairly small effect for an instrument of small duration. So again, the volatility of the underlying instrument determines its risk, and therefore there will be an inherent multiplier. For a low duration of an instrument, you're going to have a low multiplier to compensate you for a low risk. And if the instrument was like a 30-year instrument, which is extremely long instrument with a very high duration, you will essentially get a high multiplier to compensate you for high risk. Is this, guys, clear? Alright, so let's see what's next. Now, the multiplier, besides the duration, also has another important feature, and it is to provide leverage. So, you can customize with the multiplier for the duration, but in addition to the duration, you can further build in more leverage. A higher multiplier will provide a higher leverage for the instrument, and a lower multiplier will provide artificially lower leverage for the instrument. So, for example, you bought a credit default swap for GE, you got a multiplier of 10, GE blows up, you're going to be getting 10 times more than the regular compensation. Well, you yourself leveraged up. Of course, the higher multiplier will also imply a higher premium that you'll be paying upfront, but this is a mechanism to leverage up the credit derivative, or alternatively, to customize the leverage of the instrument to as much as you want. In other words, if the natural leverage is 10, you may provide a multiplier of half to reduce the leverage to 5, or you may have a multiplier of 3 to enhance the leverage from 10 to 30. Either way, it allows to customize that built-in cumulative leverage. Alright, let's see. Oh, there is another important characteristic, which is the concept of delivery. How are they going to pay you back? When when your car is totally wrecked, are they going to buy you the same car of the same quality, or they're just going to pay you cash? So delivery is the same as settlement. It might be that on the one side, the credit instrument will be delivered on the one side, and when you deliver the credit instrument, the other guy, the insurer, will give you a payment. But what would happen if the credit instrument itself disappears, or itself is no longer legal? So you may have those sorts of credits where There is no instrument, there is nothing, it just disappears. Well, if that's the case, it has to be specified. In other words, when there is the event, what will be the one party giving to the other and what will be the other party giving to the first one. Are we guys done? Is it time?
Yeah.
Alright, let me try and see to take a look if I have, I have at least one very important point, the credit events. Let's take another 3-5 minutes to complete the section. So, 1, 2, 3, 4, 5, let's write out 6, which is credit event. So every single credit derivative must have specified what the credit event is. So credit event simply is that thing, the event which triggers the credit derivative to initiate payments. So you have all sorts of them. And number one, which is the simplest, again, credit events typically must be all specified. They must be explicit. But I'm just giving you most of the examples, which are almost always present. Number one is default. Of course, if the guy, whoever the borrower is, simply defaults, then the credit event is triggered. Well, here is a key. You can't just say default, you gotta have a definition of a default. What is considered a default? The guy misses payment and he's in default the next day, or the guy misses, let's say, a payment, default comes 90 days from that point. Well, what if the guy owes, the business owes the payment is due 1 million and they made 999,000, let's say, and they just couldn't make only 1,000. So out of 1 million, they made all but 1,000. So you gotta have a clear definition. If you made 99% of your payment, are you in default? If you were just late for 2 days, are you in default? So default has to be clearly defined what will be considered default. Now, number two is bankruptcy. Bankruptcy, so a typical credit event is that the borrower himself, GE or GM, files for bankruptcy. Well, that is clearly a credit event. Another will be, which is similar, insolvency. I don't want to get into the technical differences. One is illiquid, the other one has negative equity. So one is cash constrained, the other one just doesn't have its own capital, has turned negative, sustained too many losses, but could still be liquid. So these represent an example. Another example is restructuring. A loan or debt is typically or can be typically restructured. You borrowed for 5 years, 5 million, your annual payment will be 1 million, you're in trouble in year 2, you say, hey, I'm in trouble, I need to reschedule, give me another 8 years so that we extend the loan from 5 years to 10 years and this will reduce my annual payments in half. Well, this is called loan or debt restructuring, where restructuring simply means that the terms of the loan are changed. Well, typically restructuring will be considered a credit event and therefore part of the credit derivative. Another major example is rating downgrade. So, the company has AA credit rating and it's downgraded to A credit rating. You have to define what is credit rating downgrade. Is one notch enough to trigger the event? Or is it 2 notches, 3 notches? So how many notches the credit rating must slip in order to call it clearly, oh, credit event? Usually 1 notch will not be considered a credit event, maybe 2, maybe 4, again, depends. And let me see, credit, finally, credit spread threshold. Threshold, I'm not sure how threshold is spelled. Let me see. Alright, I wouldn't bother. Oh. THR. Alright, threshold. So, usually a credit will have its credit spread. It may fluctuate between 2 and 3%. If you say, hey, we put in a threshold of 4%. If it hits 4%, it's a credit event. You trigger the whole procedure. And I think, guys, that I am done for at least today's part. We'll continue next time or possibly next Monday with credit derivatives. I plan to finish the credit derivative in roughly half a lecture and then zoom in a little bit more in credit default swaps, which are an example or the most popular example of credit derivatives. So we're done for today with structured finance.